There's one form that can genuinely increase the amount that lands in your bank account every month. And most people who qualify for it have never filed it, simply because nobody's ever explained clearly what it does or when to use it. I want to be precise about what this form actually does, because I think clarity matters more than excitement here. And then I want to walk through exactly who should be filing it and how. I'm Linda Foster, and the form I'm talking about is called the SSA-44. Let me explain exactly what it does, because I think the way most people hear about this gets slightly oversimplified. Here's the situation this form exists to fix. Medicare premiums, specifically the income-related surcharge added on top of the standard Part B and Part D premiums, are calculated using your tax return from 2 years ago. Your 2026 premium is based on your 2024 tax return. This is simply how the system is built, because by the time the New Year's premiums need to be set, your most recent tax return often hasn't been filed yet. The problem is obvious once you say it out loud. If your income in 2024 was significantly higher than your income is now, perhaps because you were still working, or you had a one-time spike in income from something like a property sale, you could be paying an elevated Medicare premium right now, based on money you're simply not earning anymore. That premium is typically deducted directly from your Social Security check before it ever reaches your bank account, which means a lower premium translates directly into a larger net deposit landing in your account each month. This is the part where I want to be precise, because the form itself doesn't increase your actual Social Security benefit amount. Your benefit, the number calculated from your earnings history, stays exactly the same. What changes is how much gets deducted from that benefit for Medicare before the remainder is deposited into your account. For someone whose premium drops because of this form, what changes is genuinely the amount you see hit your bank account every month, even though the underlying benefit calculation hasn't moved at all. Now let me explain exactly who this applies to, because not everyone qualifies, and the form requires what's called a specific life-changing event. The SSA-44 lets you ask Social Security to use a more recent year's income, instead of the 2 years old tax return they'd otherwise default to, but only if you've experienced one of several specific qualifying events. These include work stoppage or a reduction in work hours, marriage, divorce or annulment, death of a spouse, loss of income-producing property due to a disaster, or a reduction in or loss of certain pension income. The most common situation by far is retirement itself. If you worked through most of 2024, earning a salary, and then retired sometime in 2025 or 2026, your 2024 tax return reflects your old working income, but your actual current income is now considerably lower. This is exactly the gap the SSA-44 is designed to close. Let me walk through the numbers for 2026 specifically, because seeing the actual dollar amounts makes this concrete rather than abstract. The standard Medicare Part B premium in 2026 is $202.90 per month. If your income from the relevant tax year falls between $85,000 and $107,000 as a single filer, you'd be paying an additional surcharge on top of that standard amount. And the surcharge tiers climb from there as income rises, with separate, generally similarly structured tiers for married couples filing jointly. For someone whose 2024 income was elevated because they were still working full-time, and whose actual 2026 income is now well below even the first surcharge threshold because they've retired, successfully filing the SSA-44 can eliminate that surcharge entirely, sometimes recovering well over $70 a month, every month, for as long as the lower income situation continues. Here's something specifically relevant to widows and widowers, since the death of a spouse is itself one of the qualifying life-changing events. If your spouse passed away and your household income has genuinely decreased as a result, perhaps because their pension or salary is no longer part of your combined income, you can file the SSA-44 specifically citing this event, providing your current estimated income, and request that Social Security recalculate your premium based on your new, lower household income, rather than waiting for the standard 2-year look-back to eventually catch up. I want to walk through exactly how to fill this form out because the structure matters, and getting it right the first time avoids unnecessary delays. Step 1 on the form asks you to identify which specific life-changing event applies to you, and the date it occurred. Be precise about the date since this anchors everything that follows. Step 2 asks about the more recent tax year already on record, essentially confirming the older income figures the SSA currently has on file, which you'd find on your tax return from that year. Specifically, your adjusted gross income and any tax-exempt interest income. Step 3 is where you provide your estimate for the upcoming or current year, the actual figure that reflects your life after the qualifying event. You'll need to estimate your adjusted gross income and tax-exempt interest for this more recent period, along with your expected tax filing status. You'll need to attach evidence supporting both the life-changing event and your income estimate. For retirement specifically, this might include a letter from your former employer confirming your separation date or your final pay stub. For a spouse's death, a death certificate is the standard documentation. For other events, the specific evidence required is listed directly on the form's instructions. Once completed, you sign the form and either mail it or bring it directly to your local Social Security office. The form itself estimates roughly 28 minutes to complete once you have your documentation gathered, which is a genuinely manageable amount of time for something that can produce a recurring monthly increase in your net deposit. I want to address something important about the timing and the ongoing nature of this. Filing the SSA-44 isn't a one-time fix that resolves itself permanently, regardless of what happens afterward. Step 3 of the form specifically asks you to estimate your income for the year following your life-changing event. And if you don't complete that section, Social Security will simply revert to using the figures from Step 2 going forward in subsequent years, unless one of several specific conditions applies. This means if your income changes again in a future year, you may need to file an updated request to keep your premium accurately reflecting your current situation, rather than an outdated snapshot. Let me also address a specific and genuinely common situation, because I think it illustrates exactly how this works in practice. Say a widow's husband passed away, and she's reporting his death as her qualifying life-changing event specifically for Medicare premium purposes. She's already notified Social Security about the death itself, separately, for benefit purposes. The SSA-44 is a distinct additional step, specifically addressing the Medicare premium calculation that doesn't happen automatically just because the death itself has already been reported elsewhere in the system. She'll need to complete this form specifically, estimating her new, lower household income now that her husband's income is no longer part of the household total, and attach a copy of the death certificate as her required evidence. I also want to mention something about filing status changes specifically, since this connects directly to the widow and widower situation. When a spouse passes away, the surviving spouse's tax filing status typically changes, often eventually to single, which affects which income thresholds apply to the IRMAA calculation. The form specifically asks you to indicate your expected filing status for the relevant year. And getting this detail right matters, since the surcharge thresholds differ meaningfully between single filers and those filing jointly. Let me close with the action I want you to take if any of this applies to your situation. If you've retired, married, divorced, lost a spouse, or experienced a significant reduction in your income through one of the other qualifying events listed on the form, and your current Medicare premium feels like it's based on outdated, higher income figures, download Form SSA-44 directly from ssa.gov, gather the documentation specific to your situation, and either mail it or take it to your local Social Security office. This isn't a loophole, and it isn't something hidden from the public. It's a standard, established process that exists precisely because the 2-year look-back built into Medicare's premium calculation can't account for sudden, legitimate changes in your life. The form exists to let you tell Social Security what's actually true about your current income, rather than waiting for the system to eventually catch up on its own timeline. If this was useful, please share it with someone you love who's recently retired, recently widowed, or who's experienced any significant change in income, and who might be paying a Medicare premium based on numbers that no longer reflect their actual life. Let me go deeper into a few specific situations, because the practical details genuinely determine whether this process goes smoothly or gets delayed. I want to address what happens if your situation involves a property sale rather than retirement, since this is one of the qualifying events that produces a meaningfully different calculation. If you sold a home or other significant asset in a prior year, That sale likely produced a large capital gain that temporarily inflated your income for that specific year, which then fed into your IRMAA calculation 2 years later. Unlike retirement, where your income genuinely and permanently dropped, a one-time property sale represents a temporary spike that will naturally work its way out of the calculation once enough time passes and a more typical income year becomes the basis for your premium. The SSA-44 form's qualifying event for this situation is specifically described as loss of income-producing property, which covers situations like a disaster destroying a rental property you depended on for income, rather than simply selling an asset you owned. If you sold your home to downsize in retirement, this typically doesn't qualify as a life-changing event under the form's specific categories, even though it genuinely affected your tax return for that year. Understanding this distinction prevents the frustration of filing the form for a property sale and having the request denied, when the better approach in that specific situation is simply waiting for the 2-year look-back to naturally resolve itself once your income returns to its normal, lower level. I also want to address something specific about pension income reductions, since this is a less commonly discussed qualifying event, but genuinely relevant for some retirees. If a pension you were receiving has been reduced or eliminated, perhaps because a former employer's pension plan was restructured, or because you were receiving a pension tied to a specific period that's now ended, this can qualify as a life-changing event under the form's provisions. The same documentation principle applies. You'll need evidence of the reduction, typically a letter from the pension administrator confirming the change and the date it took effect. Let me walk through what happens after you submit the form, since understanding the typical timeline helps manage expectations. Social Security generally reviews these requests and, once approved, adjusts your premium going forward from the point of determination. This isn't typically instantaneous, and processing times can vary, but the adjustment, once approved, applies to your premium for the remainder of the relevant period, and in most cases produces a recalculation rather than requiring you to wait until the following year's standard cycle catches up naturally. If your request is denied, you do have appeal rights, since the SSA-44 itself describes the process as a request for a new initial determination, rather than a formal appeal of an existing one. If you believe the denial was made in error, or if your specific circumstances genuinely meet one of the qualifying categories, even if the initial review didn't see it that way, you can pursue a formal appeal. Though I'd note that for a relatively modest premium difference, it's worth weighing the time and effort against the potential benefit before pursuing a lengthy appeal process. I want to address something for married couples specifically, since the IRMAA brackets and the SSA-44 process work slightly differently depending on filing status. If you and your spouse file jointly, your combined income is what matters for the joint thresholds, which are generally roughly double the single filer thresholds at each tier. If one spouse retires while the other continues working, the household's combined income may not drop as dramatically as either spouse's individual income did, which is worth calculating carefully before assuming the form will produce a significant premium reduction. Running the actual numbers, using your specific combined income estimate for the relevant year, against the published IRMAA brackets, tells you clearly whether filing is likely to produce a meaningful result before you invest the time in gathering documentation. Let me also mention something about the relationship between this form and the broader retirement income planning conversation, since I think it's worth connecting these dots for anyone watching this who's approaching retirement but hasn't yet filed. If you know retirement is coming in the near future, and you can anticipate roughly when your income will drop, you don't need to wait until after the fact to think about this. Once your retirement date is confirmed and you have your final pay information, filing the SSA-44 promptly, rather than waiting months or assuming it will resolve itself automatically, means you start recovering the difference in your monthly deposit sooner rather than later. Every month you wait to file, after your income has genuinely already dropped, is a month you're paying a premium based on income you're no longer earning. Money that doesn't automatically get refunded retroactively in most cases, simply because you eventually got around to filing the paperwork. I also want to mention something specific about how this interacts with the broader senior bonus deduction conversation that's been relevant since the tax legislation passed in 2025. If your adjusted gross income, after applying the new deduction available to seniors 65 and older, drops below a specific IRMAA threshold for the relevant tax year, that lower figure is exactly what you'd report on the SSA-44 form when estimating your current year's income. The deduction and this form work together in the sense that a properly applied deduction can be part of what genuinely brings your income below a surcharge threshold, making the SSA-44 process even more valuable for some retirees than it would have been before this deduction existed. Let me close this deeper section with one final point I think matters. This form exists because Congress and Social Security recognized, correctly, that a rigid 2-year look-back doesn't reflect the reality of people's lives, particularly around major transitions like retirement and bereavement. It's not a workaround or a clever trick. It's the system working exactly as it was designed to work, for exactly the situations it was designed to address. The only reason it goes underused is that most people have simply never been told it exists, or have heard about it only in vague, oversimplified terms that don't explain clearly what it actually changes. If you've recently retired, lost a spouse, married, divorced, or experienced one of the other specific qualifying events, and your Medicare premium hasn't yet caught up with your current reality, this is genuinely worth the 28 minutes the form estimates it takes to complete. If this was useful, share it with someone you love who's navigating exactly this kind of transition right now. I'll see you in the next one.